Thank you for joining me on this video. My name is Rodney Constable. I'm the president of Simple Market Signals. On this video, we're going to be taking a look at the difference of S&P 500 ETFs versus the mutual funds. And on this first screen, what I've done is I've loaded up 7 different S&P 500 investments, and you can see the ticker symbols up here, including the S&P 500 index. So we have the SPY, the SPY, we have the IVV, which is the BlackRock ETF. We have the VOO, which is the Vanguard ETF. And then we have the FXAIX, which is the Fidelity S&P 500 mutual fund. And then on down the line here, we have the Charles Schwab S&P 500 mutual fund. Then that's the SWPPX. We have the VFINX, which is the Vanguard S&P 500 fund. And then we have the SVSPX, which is the State Street Global Advisors S&P 500 index fund. And these investments range from an expense ratio of 1.5 basis points all the way to the most expensive one is looks like 16 basis points. Okay, so guys, first off, I want you to understand that and hopefully this will save you for the rest of your life ever even having to think about this, ever having to go back and try to research this. You know, so many times I see Google queries or people talk, what's the best S&P 500 index fund, and index fund versus ETFs. Guys, what I want you to see here, this is for the last 252 trading days, so it's a full trading year, right? There's about 250 plus trading days in each calendar year. And let's just start over at the left, and hopefully you can see this. It's going to be much better if you're looking at this on a larger screen. But the S&P 500 index itself is up 23.79%. Now, the first thing I want you to understand is the index itself, number one, is uninvestable. You cannot invest directly in the S&P 500 index, okay? You can invest in these products, which, you know, they try to replicate it, but the S&P 500 index in and of itself is not investable. Therefore, it's somewhat disingenuous to compare things to the S&P 500 index and say, well, you know, if you'd invested in the index, well, you can't invest in the index, all right? The other thing I want you to understand about this is that this number here, the 23.79% for the last 252 trading days on the S&P 500 index, does not include the dividends, right? There's a 2.25% dividend on the S&P 500. So when we move over here and we look at the SPY, which is the first investment here, this blue bar, that is up 26.08% during that same time frame. It's not that the SPY necessarily outperformed the S&P 500 by that much. The rest of these investments are total return, where the S&P 500 itself is on a price performance basis. So these other investments include the reinvestment of dividends, okay? But as we go across here, you can see that each one of these is almost identical, all right? We've got 26.08%, 26.23, 26.22, 26.26, 26.26, 26.11, 26.04. So, guys, the entire spread of best performer to worst performer, the worst performer is up 26.04%. The best performer is these two, up 26.26%. And guess what? The best performer, they're mutual funds, okay? So people, you know, what's best, ETFs or mutual funds? Guys, this is what I want you to stop focusing on little minutia, right? We've got to get to the big picture stuff. So there isn't, I mean, the different, if your investments, right, if your success as an investor or a trader comes down to a few basis points of expense, basis points of return, and a basis point for a review, and I've got a video on this out of my YouTube channel that you will probably want to go review because it's very good. But a basis point, just for a quick review, is 1/100th of 1%. Okay, so 0.01% is 1 basis point. So the difference here of being up 0.26 or 0.04, right, 26.26 to the difference of 26.04, the basis is what, or the difference is what, 22 basis points? A little less than 0.25% difference across the last year on these two, the best performer to the worst performer. So I hope I'm getting my point across here, guys, that I hope you never waste another second of your life reviewing but stick with me here on this video, because there's a lot of great stuff I'm going to share with you. But the first thing I want to get out of the way is, and we're going to look at some different time frames here so you really understand this, but it's not about mutual funds versus ETFs. It's not about necessarily. Now I'm going to give you a couple reasons why you may want to choose one versus the other, or you may be forced, depending on the type of account you're working with, to be in one investment versus the other, a mutual fund versus an ETF. But stick with me here. This will all make sense. But from a performance standpoint, from an expense ratio standpoint, guys, if you're, what's the cheapest? What's the best S&P 500 index product? Guys, they're all so similar, it doesn't matter, okay? Stop wasting your time thinking about this. Stop wasting your time researching it. Hopefully this video will put this all to bed for you, okay? But stick with me. I've got a lot of really good stuff for you that's really going to help, all right? So let's go ahead and back this up and just understand that the S&P 500 as the index is going to underperform as we go and look at a longer and longer time frame, because the lack of dividends being reinvested. We're just looking at that on a price-weighted basis. But as I start to back this up, okay, and you can see here on the upper left-hand corner of the chart, you can see where my cursor is. We're backing this up now, and down in the lower right-hand side, again, you probably want to watch this video on a larger screen, but that's 590 trading days so far. And as I back this thing up, you can see here that even when I get over it, let's go to about 1,200 trading days, and let's see here. Anyway, so, I'll just take this thing to the max. There we go. So going back to the common inception of the oldest or the youngest product, there's 2,201 trading days of data here, all right? And as we can see, the SPY, which, by the way, it doesn't really matter, but that's the ETF that I use when I'm working with the S&P 500. It's the one I like, and I'll get to some points on that here in a second. Over the last 2,201 trading days, it's up 193.78%. Then we've got 195.32, 194.25, 194.94, 194.72, 192.92, 192.13. So even over years and years, right, going clear back to May of 11 through the 10th of February, which is yesterday, making this video on the 11th of February. And remember, well, I'll get to that point in a second, but you can see here, guys, that we're talking a couple percentage points difference. So it doesn't matter. Choose one of these things and stay with it, all right? Now, with that said, the difference between ETFs and mutual funds, all right, if you have, it depends on the account you're in. So if you're in your 401k or 403b at work, you probably will have to stay with the mutual fund, all right? But if you're in an IRA or a non-qualified account, a regular trading account, then you will be able to use an ETF. Now, the advantage of the ETF over the mutual fund would be that the ETF has, in most cases, the ability to you're going to have, first off, you're going to have intraday liquidity, I-N-T-R-A, day liquidity. In other words, you can buy and sell it during the middle of the day, where on a mutual fund, you can't get out in the middle of the day, right? When you place an order to sell a mutual fund, even if it's 9:31 a.m. Eastern Standard Time, which is the stock market opens at 9:30 a.m. Eastern Standard Time, even if you place that order on a mutual fund at 9:31 in the morning, you get the closing price that day. You get the net asset value, as it's called on a mutual fund, at 4 p.m. on that day. That's your exit price. So if the stock market drops, 1, 2, 3% during the middle of the day, after you place the order, you're going to be down that much, okay? So that's just the way the mutual funds work. The whole industry works that way. Everybody gets the exact same selling price at the end of the day on that particular day when you're selling or buying a mutual fund. Okay, so that's 4 p.m. Eastern Standard Time. Whatever that closing price is on any mutual fund, that's the price you get. Now, with the ETF, it trades just like a stock. So that's one of the advantages of an ETF over a mutual fund is that you're going to get intraday liquidity. You can also have stop losses. So that's another reason why the ETF may be the better choice. It's not, but again, I hope I'm clearing this up, guys. It's not about expenses. It's not about performance. It's about functionality. It's about optionality, what you can do with it. So the ETF has intraday liquidity, stop loss protection, and speaking of options, most ETFs also have the ability for you to have calls and puts. Okay, and so that's another reason. I use the SPY, the SPY. It's an old ETF. I think it actually is the very first ETF. The inception on this thing is January 22nd of 1993. I just looked it up. So the SPY, that's this one here, has been around since the early 90s, okay, 93. So it is a very old product, and it's also the largest by AUM. That's assets under management. That's industry speak. So in the financial services industry, whatever the AUM, the assets under management in a product, that's called your AUM. So the SPY, the SPY, is the largest ETF on the planet. It has more assets, I believe, than at least most days and most years. It will be the largest ETF out there. Not that that really matters, but just some education for you. And it has you can write covered calls on the SPY. I've done that. You can straight up buy calls. You can buy puts to protect yourself. You can do spread strategies, whatever. So those are the advantages of the ETF versus the mutual fund. But as you can see, from an expense ratio standpoint, from a performance standpoint, guys, you forget about it. It doesn't matter anymore, okay? Stop looking and stop chasing basis points. Look at the bigger picture. And I'm going to give you a couple of things here, other things to think about with respect to this type of an investment. Now, another thing, okay, just education for you. You see these X's at the end of these. So each mutual fund, right, every mutual fund, just a little tidbit for you, but education, all mutual funds end in NX. So the VSPX, okay, you see how the X is the last letter in the 5-digit ticker symbol for a mutual fund? All mutual funds, and I'm a former mutual fund wholesaler. I was a vice president regional sales manager for Oppenheimer Funds, the mutual fund company. I worked there for over a dozen years. And anyway, these are the kind of weird little things you learn when you're doing that kind of job. But just for your knowledge, mutual funds have a 5-digit ticker symbol, and they all end in an X. So a little trivia for you. All right. Now, bigger picture here, guys. So hopefully you can see over a longer time frame. Let's just kind of recap real quick before we move on. There's not a lot of difference between any of these products. You're talking even over many, many years. You're talking minuscule, a couple percentage points difference over, 8, 9, 10 years of trading. So it's not about which S&P 500 product you're using, okay? It doesn't matter on the expense ratio. So forget about that. Just focus on what's more important. Now, if you have the option no pun intended, if you have the option to use the ETF over the mutual fund, the reason I would choose the ETF would be because of intraday liquidity, stop loss protection, and the ability to use options, either writing covered calls, and you can even write covered calls in an IRA. And if you don't know all these things I'm talking about, go out to my YouTube channel. I've got a lot of videos on these things. Or if it's not on my YouTube channel, then just go out and Google these things and keep educating yourself if you don't understand everything I'm talking about. All right. But at the very least, just stay with me here because I've got some more really good stuff for you. Okay. So let's back this up so you can kind of see some different time frames, and let's just go to maybe 1,000 trading days, and we'll run through the data real quick, and then we'll move on to the next point of this video. But again, I just want you to understand that there just isn't a lot of difference. Let's get it down to as close to 1,000 days as I can. There we go. All right. So the SPY last 1,000 days is up 88.38%. This would be the IVV. It's up 88.94, 89.09, 89.26, 88.93, 88.33, 87.58. So again, Guys, we're talking, 1 to 2 percentage points difference over the last 1,000 days. It's just not a big enough difference to worry about, okay? Now, if you really, really want to make a difference in your trading and your investing, what you need to do, and as I alluded to when I opened this video, I am the president of Simple Market Signals. I've got 20 plus years of experience in financial services. I've been trading stocks and options since the early 90s. And so I've been at this a while, and I've learned a few things. And one of the things that I've spent a lot of time on is technical analysis, and I have other videos out of my YouTube channel on technical analysis of the S&P 500, so go out and take a look at those. But the bottom line is technical analysis can only get you so far, all right? And the other thing you need to understand is the economy and the stock market are not the same thing. So the other thing I want to impart to you here is please don't study economics and try to base your investment decisions on what do you think the economy is going to do and then expect a direct correlation, because economic data is lagging data, okay? Economic data is lagging data. What we need to do is we need to focus on the stock market. And so for my own personal trading and investing, I spent decades trying to figure out and do research on what really matters and what doesn't. And finally, in 2017, again, for my own personal trading and investing, it all finally came together. And this is when my model, which I call Simple Market Signals, was born. And it's an aggregation of numerous data points within the stock market and the bond market. And it's looking at a myriad of indicators as well as technical analysis, intermarket analysis, and you have to understand how to read all these things, and then you have to understand the levels, the valuations in each one of these things in order to really make this work. And like I said, I spent over 20 years working on this. And let me show you the results. So let's go back to 2018. So now we've talked about, and hopefully you're with me on this, that chasing basis points and trying to figure out what's the cheapest or the best performing S&P 500 fund, that it doesn't matter, right? You're wasting your time. But what does matter is understanding what's called systematic risk in the market. And systematic risk, by the way, guys, is non-diversifiable. So you can add more and more things to your portfolio, and you are not going to affect systematic risk. It's the system, right? It's all equities together, because over time, what happens when the stock market starts to fall, pretty much everything starts to fall with it. So correlations increase as the market starts to go down. Now, what you're looking at here is 2018 in the S&P 500, okay? And what I've done here, my model, I've got it down, my Simple Market Signals is green, yellow, and red. Okay, I distilled down my signals to something we all understand, right? Any of us that have driven a car, right? We know that green means go, yellow means caution, red means stop. That's the basic tenets of my signals in my Simple Market Signals model. And you can see here that 2018, it was a tough year. And by the way, the S&P 500 was down on an absolute as well as price basis. So even with the just looked it up here before making this video. Even when you reinvest the dividends back, the S&P 500 was down 4.75% in calendar year 2018. But check this out. What would happen, right, if you just, and this is just a hypothetical at this point, but what would happen if you just invested in one of the S&P 500 type products during the green periods within my model? So you can see here during the first part of 2018, right, for the first month, basically the month of January, before the signal went yellow and then red, and I just kind of batched the yellow and reds together in the 2018 analysis here just to make it easy to understand, to get the point across. But you can see here you would have made money there, and then you could have got out, captured your profits, and set out this time frame. Now, on occasions, and this is just the way the model works, on occasions you will get a very short signal. It doesn't happen very often, but it does happen, where you might get in and out at around the same price, okay? And it could be on any of the signals, but you can see here it was a green signal that didn't last. It just, it only stuck around for about 2 weeks, and you would have gotten back out. You might even have taken a small loss there. The signal turned yellow. You got, and let's just say, for instance, you got out on the yellows, okay? And then you sold here, you got back here. Well, as you can see here, you would have bought in at a slightly higher price. That's the price you're going to pay for quote unquote insurance, right? The insurance of knowing that you're preserving your capital, that you're focusing on the big picture, right? You're focusing on things that really matter. And simple market signals is a risk reduction system. That's really the basic job of this model, is to help you understand the unit of risk that you're taking per unit of possible return. And what you see here is when the model is green, when the signal is green, this is your best risk-reward ratio signal. When the signal is yellow or red, those are the two worst risk-reward ratio signals, okay? And what I have found through my decades of research, and after getting this model finally put together in 2017, and again, I originally created it for myself, and then after I had worked with it for a little while, I realized how special this thing was, and I was like, man, there's a lot of people that could really benefit from this. So I built a business around it, okay? And stick with me. I want you to understand, guys, it's super cost effective, all right? Most of you probably spend more money at Starbucks in a month than what this product costs. So stay with me. I'll get to that here in a second. But I promise you, it's really, really affordable. All right, now, so you can see here in this green signal, you'd have been back in for about 3 months, and again, you would have made money here. And then the signal went yellow and then red, and I just batched the yellows and reds together in 2018, at the tail end of 2018, just to make it easy to understand. And again, if somebody was a buy and hold investor, they didn't make any changes to their portfolio, and they were in the S&P 500 for the entire year, they lost money. Now, let's move on to 2019. And so coming into 2019, again, you can see that we were still red. So the first thing I want you to understand is the model is not going to pick the exact bottom, or the exact top for that matter, of the markets, okay? It just doesn't work that way. The markets oftentimes will bottom very quickly and bounce. And again, it's a conservative system. So don't expect to pick the exact bottom. It's not going to happen. But I'll show you something here in a second. I think you're going to be pretty surprised about this. But anyway, so you would have gotten back in, right? If you only, and again, just hypothetical, you'll have to figure out, if you do want to work with me, you'll have to figure out how you want to use these signals. It's always up to you. I just send you the data. You do with it what you want, right? But a lot of people just rebalance their portfolios on a signal change. Some people will trade. It's entirely up to you. But let's just say, for hypothetical purposes, that you only invested on the green signals. You were in cash when it was yellow and red, right? Just to kind of get a point across. But you can see here, you would have got in here when it was green, and you could have gotten out here in the yellow and taken your profits there, set out for a few weeks, and you would have gotten back in here, again out here, again short yellow. But again, you can see you would have sold and then bought back in at a slightly lower price. This green signal was kind of a sideways. Again, it's unusual, but it does happen, where you could have gotten in and out around the same price. You might even have lost a little bit on that one. And then same thing here on this yellow. You sold out, bought back in at a slightly higher price. Again, that's the price you pay for quote-unquote insurance, okay? The insurance of knowing you're not going to get wiped out. So you got in here, and then you got back out here. Now, this was a super short. This is the shortest yellow signal, and one of the shortest signals, period, I've had in this model since it finally came together in 2017. But this was literally a 3 trading day signal where it was yellow and then went right back into green at the tail end of 2019. And you can see here again that that we marched on in. And as I'm making this video, we've had one little short yellow signal that happened about a week ago in 2020, and we're right back to the green, and the markets are marching forward. So it's been quite a run here, especially since the middle of October. Now let's go back and take a look at the transition from calendar year 2018 into 2019, because I really want to drive this point home. If you would have sold when the signal turned yellow in the first part of October 2018, you would have gotten out around the 2,900 mark on the S&P 500. And then when we look at when the signal went from red into green, if you go across here, you're going to notice, right? Let's just go across, and you can see that signal would have happened around 2,750 on the S&P 500. So you would have gotten out at 2,900, and you would have gotten back in at 2,750, saving yourself that 150 S&P 500 points to the downside. So I just wanted to make sure you saw that since we're looking at each calendar year by itself. So I hope you're seeing the beauty of this system. The way I disseminate this information, right, the way I distribute it is through a weekly newsletter, okay? And if you are interested, you can go out to my website. It's simplemarketsignals.com. So it's HTTPS. It's a very secure site. That's what the HTTPS is all about, :/simplemarketsignals.com. Okay, it's a weekly newsletter. Guys, it's $19.95 a month. That's it. It's less than $5 a week. Okay, but this is what you're going to be able to do. You've seen 2018 and 2019, what this would have done for you. Now, whether you want to be really active and only invest in the green periods or whatever, but just having this information, and I pack these newsletters full of all kinds of stuff, but the heart of my newsletter is the signals, and I even give you signals on every single sector of the S&P 500. So you're going to get signals on all 11 sectors of the S&P 500 plus the S&P 500 itself. And even if you don't invest directly in the S&P 500, the correlations to most other equity products are so high these days that if you understand where the S&P 500 is going, it's going to give you a huge advantage over other traders and investors, irrespective of what you're actually investing in. You can invest in individual stocks, you can invest in sectors, you can invest in even the international products, because you're not going to see very often where the international markets, at least most of them, are going to go opposite of the U.S. markets. Okay, so it's really important that you understand systematic risk. And please, please, please remember this: you cannot diversify away systematic risk. Okay, and I'll get to other videos on this, so look for that. But as a matter of fact, I do have other videos on it, but I'm going to produce even more of those. So take a look around my YouTube channel, guys. I've got a ton of really educational videos out there. I've got a video that shows you the math behind what it takes to build a $1 million 401k. So if you like the sounds of this, you understand it's only $19.95 a month. First thing you have to do when you go out to my website is you have to accept the cookies, and then you just click here to get started. It's a super easy process. Just follow the prompts, and it'll take you 4 or 5 minutes at all. That's it. It just takes 4 to 5 minutes. Input your data, get your credit card in there, your email, because again, it's an emailed newsletter, comes out every weekend, and the first 2 weeks are free. So guys, there's no contracts. You can cancel at any time. So after a few weeks or a few months or whatever, you don't like my data, you don't like it, it doesn't work for you, just cancel your subscription, right? You have, there's just no risk, all right? But let's just kind of go back here and review. This is what could have happened for you in 2018, in whether you want to outright trade just in these areas or rebalance your portfolios. A lot of people will just do that. Rebalance when there's a signal change, okay, tactical rebalancing. That's one way to use this. Or if you're more of an active trader like myself, then you're going to be invested in the green periods, because that is your best risk reward ratio signal. And again, to emphasize this, in working with this data now for several years, what I can tell you is the market will really only rise when the signal is green, okay? Because I've reverse engineered the way the market works. I'm using market data. My model is not influenced at all by opinions, including mine, forecasts. I don't make forecasts. We're working with current data, news headlines, politics. It looks through all of that, and lagging economic data. So the model is based on the market itself, the U.S. stock market, primarily the S&P 500. But again, guys, it doesn't matter what you're investing in. This will help you because the correlations are so high. And again, systematic risk is the key to being successful going forward. Okay, so hope you've enjoyed this. And again, go out to simplemarketsignals.com, sign up. First 2 weeks are free. It's $19.95 a month. Billed monthly on your credit card. And thank you for being on this video, and I look forward to working with you.